0,35. Es una isla, España y Francia, que se acaba de poner en positivo 0,01 en el entorno de mercado europeo. Mira, y también el italiano, subida del 0,01. Está con nosotros Terry Edwing, director de Renta Variable de Mediolanum Internacional de MIFL. Good morning, Terry.
Good morning, Jose.
The first 6 months of 2022 have seen the biggest fall in equity markets since 1970. What's your outlook for equity markets for the rest of the year?
Well, we are buyers of the equity market on further weakness rather than sellers on strength. This is the worst start to a year since the Beatles were #1 in the charts. So let me explain. Equity markets have fallen sharply, as you mentioned, and they closed out the first half down in euro terms on a global basis, just short of 15%, about 13% in the US. Europe was close to 20%. Spain fared a bit better, down 7%. So the market has had multiple headwinds to deal with this year, including, of course, the tragic Russian war in Ukraine, sharply higher oil and gas prices resulting from that, and they've risen over 50%. On top of that, commodity prices in general have contributed to a very sharp rise in wages and inflationary pressures generally. This has been followed by, of course, tighter monetary policy and, sadly, weaker economic growth. Now, markets hate uncertainty, and there are many concerns that are yet to be fully resolved. However, in the second half of 2022, we expect to have a better understanding of the persistence of inflationary pressures and central banks' response to these in terms of peak interest rates, the pace of the economic growth, and the outlook for corporate profits. So at Mediolanum, we believe that a lot of these risks have been repriced into the equity market. The valuation of the market has derated sharply from the end of last year, and as markets have fallen back to a more realistic valuation level, we would be buyers on weakness, as I said, rather than sellers on strength, and we believe that further weakness in equities in the second half of the year, when uncertainty will be at its greatest, will, in our opinion, likely prove to be a good opportunity and a good entry point for our clients over a 3 to 5 year time horizon.
What impact are higher interest having on the economy and financial markets?
Well, as the outlook for inflation has deteriorated, central banks have had to respond robustly by raising interest rates. We have seen the highest inflation prints in 40 years. So the focus has shifted from monetary easing to a much tighter monetary policy. We expect the ECB to raise interest rates by between 200 and 250 basis points, and the Federal Reserve to raise rates by about 300 basis points or 3% by the year end. This combined with a cost of living crisis and a sharply higher inflation outlook is causing a slowdown in the global economy. But there are already signs of some commodity prices weakening and economic data softening. So the central banks, by talking tougher on monetary policy, are already succeeding in slowing the economy. And we have seen this recently with a modest rally in bond yields. Now, unfortunately, the energy crisis caused by the Russian war in Ukraine is hitting Europe the hardest. So we expect weaker trends in the second half of this year, but before an improvement later in 2023. The stock market is, of course, a discounting mechanism. So by the end of this year, investors should be looking forward to a less uncertain outlook.
What is the outlook for corporate profits, growth, and what are some of the challenges they face?
Well, earnings growth estimates are set to fall. Frankly, we have been surprised at how well earnings have held up so far this year. However, we see significant margin pressures ahead. Companies face two pressures. First of all, the pressure on revenues. We expect higher inflation costs and interest rates to impact sentiments and cause some demand destruction. So companies face pressure on their top line sales growth. And secondly, in addition, higher costs are and will continue to put pressure on profit margins. So we expect to see weaker profit trends over the rest of this year.
Equity markets have fallen sharply this year. What conditions are you looking for that may indicate we have fallen far enough and markets may start rallying?
Sure. There are two key stages to an equity market correction. The first stage is the derating, which we have largely had. For example, the price-earnings ratio on the US equity markets has fallen from about 22 to 16 times this year's earnings. And in Europe, it's fallen from about 17.5 to 12 times earnings. So these valuations are much more in line with longer-term averages. So in our opinion, that is constructive. However, the cut in earnings estimates is largely still to happen. And as recently as this week, we noted that earnings estimates for many sectors in Europe were still rising. So there's up to about a 10% downside risk to current estimates. So we would expect to see consistent, steady cuts to estimates over the next 3 to 6 months. But once those earnings estimates reset to a more realistic level, we would view this as a key ingredient to taking a more positive stance on the equity market. And we expect this to happen in the second half of this year. In addition, we're looking for continued easing in commodity prices. As the global growth slows, we expect to see this again later this year.
Lastly, what are the key themes you are investing in your portfolio?
So we're capturing many things in our funds, but I'll maybe mention just two key themes. The tragic war in Ukraine is awful for all Ukrainians, but there'll be a long-lasting legacy of the war in terms of its profound impact on the structure of the energy market in Europe. We believe EU governments will accelerate the pace of energy transition, including, for instance, the building of many LNG import facilities, more wind and solar power, increased EV car penetration, carbon capture, green hydrogen, and stricter emission regulations across all industries. So we expect this to result in a huge commitment of CapEx across the globe. Secondly, the second key theme is more style-based. The equity market has been quite style-focused in recent years. First of all, there was a growth style winning between 2015 and 2020 when the NASDAQ 100 index tripled in a 5-year period. But when the first vaccine for COVID was rolled out in November 2020, there was then a sharp rotation to a value style. As this year progresses, we expect a transition from value to a quality investment style. What do I mean by this? Well, these are companies with strong competitive position in their industry, a high consistency of earnings and cash flow, but also with a reasonable growth rate and critically, in an inflationary environment, strong pricing power. So this increasingly is where our focus is across our portfolios.
Thank you very much, Terry Edwing, director de Renta Variable de MIFL, de Mediolanum. Good day, good business.
Good day. Thank you.